let's get to 314 Research co-founder Warren Pies for the investor take on everything we've seen this afternoon. Warren, what was amazing to me is that we did have this volatile session. You actually saw the VIX spike as all of this was playing out in the Oval Office. You saw stocks, take a leg lower. It seems like those World War III comments coming from a sitting president in the Oval Office, whether it was algos or not, seem to have been what triggered that. And yet, we finished the session at highs. The S&P up almost 1.6% today. Yes, lower on the week, but the Dow even clawed back its gains for the week to finish up almost 1%. And actually, crude oil settled lower, too. What does that tell us about how the market is reacting to these geopolitical circumstances and what is really a rewriting or a tearing up, if you will, of diplomatic normalcy?
Yeah. Oh, wow. What a day. Thank you for having me. I think that what it tells us from a market perspective is the market's getting a little bit more used to this. If we zoom out, there are a lot of emotions on each side. I think that we're all adults here. We know that this was a huge change to go from the last administration to this administration, and there have been a number of bullets fired at this market in that changeover. So, yeah, there's been a lot of volatility. Policy uncertainty is like the buzzword out there on Wall Street. But, I think the market is getting somewhat used to it. I think that the close today, it doesn't really resolve what we've seen in the markets. We've been in this historically tight range, and we're right in the middle of that range still. I think there was a lot of mechanical buying at the end of the day. And the real worries, the real concerns, if you're going to be a stock investor and think about reducing exposure is it to the economy and the growth scare that I think has started to gain traction on the street this week.
That was exactly where I was going to you with my next question, and that is we basically started the day with growth scare in focus. You had the Atlanta Fed's GDP Now model turning negative, which is something we don't see or haven't seen very often. We had a PCE reading that was basically in line with the street today, but shows that inflation's still stickier than where the Fed would like it. We've had some softer data or disappointing data as well, and we've seen this massive move in the Treasury market. I mean, we were at 4.5, maybe higher last week in the 10-year Treasury yields, and we're down at 4.2 now. So do you invest in stocks here? Do you invest in the bond market? Do you sit on your hands and go to cash? How are you thinking about it?
Yeah, well, I don't want to just tell everyone what we've already done, but it gives you some instruction on going forward. So we downgraded stocks a couple of weeks ago, and we've been riding a bond overweight since really the 10-year hit 4.6. And so, our view has been there's going to be a growth slowdown, a growth scare that's coming here, and we're right in the middle of that risk window. So I'm not ready to jump back into a real overweight equity exposure here in this market. I think when you look at it, you have the Fed meeting next month. I don't expect the Fed to do anything. I don't think they're really prepared to react to a weakening economy and the things we saw in GDP now or the things that we're seeing in the housing market. And so I think that there's no help coming from the Fed in March. And then when we get to April, one of the things we've studied is that these years that follow major bull market rally years, there's a pretty big liquidity drain that occurs starting in April. And so all of these things are kind of coming together. You have obviously the policy uncertainty and the tariffs that we've just already talked about. And we have a Fed that's not really ready to be proactive this year like they were last year. And it's occurring against the liquidity drain backdrop. So I'm not going to be overweight equities until we get through this period that we're in right now. And I'm going to hold an overweight in bonds, at least for a little bit more. We are starting to get to a place where valuations are not so attractive on bonds. But still, I think they're a great portfolio hedge, and we're going to remain overweight.